talked about this a lot, if we can, and that's about how unemployment's bad. It's like when people say markets inventories are low, that's usually a sign that the commodity prices have peaked. And what I show you in this screen is this is just, it'll come up in a second, Scott, if you can bring it up. The unemployment level in the US is bottoming from the lowest level in about 50 years. And I just overlay that every single time it does. This is the lowest level since we go back to 1969. What happened? Oh, we had a pretty significant recession. Unemployment bottoms, significant recession. Unemployment bottoms, recession. Unemployment bottoms, recession. Unemployment bottoms. It's bottom. It's the stated goal of the Fed to reduce inflation, unemployment, and making that go up is part of that deal. It's just inevitable. So to me, this is how macro and big picture we are right now.
U.S. inflation is now much slower than last summer's red-hot pace, but it's not guaranteed it will drift down to the Federal Reserve's 2% target without a sharp rise in unemployment. That possibility remains unlikely. Defeating inflation without throwing millions of Americans out of work, a scenario known as a soft landing, has always been the Fed's primary objective, according to Fed Chair Jerome Powell last week. But there are many uncertainties and economic headwinds on the horizon, including banks toughening their lending standards and the resumption of student loan payments only a few weeks away. Even Powell himself expressed some skepticism when describing the likelihood of a soft landing during his remarks Wednesday after Fed officials voted to hold interest rates steady at a 22-year high. With the yuan weak, housing in the doldrums, and stocks as insecure as ever, China's working and middle class are turning to one investment option that is regaining some shine: gold. For Chinese consumers with limited access to overseas investment products, the precious metal is one of the few ways they can try to counter the shrinking value of their other assets. The yuan is only expected to weaken, but most Chinese individuals cannot buy U.S. dollars or U.S. dollar-denominated products to hedge against the Chinese currency's fall. Mike McGlone goes into detail about the gold frenzy, explaining why gold remains the best bet for people like those living in China. He also tries to compare Bitcoin and gold when it comes to being a haven in matters like this. Let us now get into the video. Don't forget to hit that like button, subscribe, and drop your comments.
The average price for gold this year is the highest ever. Tell me another major asset you can say that about. And the key thing is that's pressuring gold recently is the stock market's had this big pump, and you can get 5.1% in a 2-year note, and gold yields nothing. That's been a pressure factor for Bitcoin too. But you did mention the key facts. One of the most significant facts is ETF holdings of gold. That's mostly investors have been down about 10% this year. That's quite significant with the gold price up. That's basically never happened. So it's showing divergent strength. It's like it should. I think gold's going to be one of the best performing assets. And it's a question of what's going to take for the catalyst to spark. It needs probably for the Fed to pivot, a sign for that potentially to pivot, the recession to kick in, no longer being able to see how I can get average annual 9% on the S&P 500 in the next few years. And I think gold will break off. To me, that's a breakout. It's a matter of time. So that Fed pivot's probably going to come from just what you see in the screens this morning, a little more weakness in the stock market. So I think gold and the stock market, S&P 500, are going to meet about 3,000. S&P 500 around 3,000, gold around 3,000. I know that's going to tweak Dave. I love when I tweak Dave, and maybe James too, but I can show you that. I'll be publishing on that tomorrow. And it's just pointing out that historic relationship between the two. And a key thing I want to point out in the simple facts of what I will be publishing in the macro big, first the smaller big picture is what we've been watching the last few weeks, just waiting for the Fed to I'll just show this on my screen if I can, show for the Fed to finally take out, if you can share it, finally take out this hiking. It's right there. It still shows hiking. This is a WIRP screen. Shows the Fed still is about 20% they're going to hike at the next two meetings, November, December. But this level here, but 5.37% compared to the Fed rate of 5.33, was as high as 5.45. That's finally inching out. That's the first baby step. And the only way to take that out, I think, is the stock market to go down. That's happening. That's where you might see that pivot towards gold, but it's so early days. We still have to get to the market, still price for all this easing. And Fed says they're not going to ease. Market thinks it's going to ease, but the stock market has to make it ease. That's your pivot, and I think that's what you're kind of seeing from weakness in stock market, weakness in Bitcoin, and specifically copper. Copper's breaking down this morning too, and that has been a good leading indicator for years.
The interest has sent spot gold prices in China to 13-year highs and widened the spread with the international price to the most in a decade. As of Monday, the spot price of gold was over 445 yuan, $61 US, per gram, resulting in a gap of about 4.7% between the domestic and international gold prices in China. In mid-September, the retail price for gold from main brands such as Chow Tai Fook, Chao Sang Sang, and China Gold had risen to 600 yuan per gram, but buyers were still not deterred. McGlone continues with his Bitcoin projection and stance, stating that Bitcoin remains the #1 risk asset, but with the impending stock market crash and recession, he doesn't see it performing so well in the short term. Let us get back into it.
Bitcoin's a 50 vol asset. It's the best performer asset in the history of mankind. And everybody's bullish, as you see, and most sentiment. And also, if you remember when the financial crisis hit, gold was a 20 vol asset and still dropped 30% from 1,000 to 700, and then it went up to 1,900. That to me is, when you have a volatility asset that's 2 to 3, 4 times a typical vol asset, when people hit stops, it doesn't go up. Maybe we'll get lucky, but that's going to happen to me. That's the next bridge. If I can share a screen, I'll show you where I think things are going. And just a simplistic measure of, you take the per ounce price of gold, which I show you there in orange, and you put that in the same scale as S&P 500. Every time we have a recession, if the gold is below the S&P 500, it takes off. If it's above it, it goes down. This has been since, we came off the gold standard in 71. So we got 50 years of history here. Right now, the S&P 500 is very expensive at 4,300. Gold's very cheap. For a recession, then I just show that in the bottom, that leading indicators has a 100% chance of predicting recessions when it's minus 7.6%. For the last 100 years is showing recession. So we're going to get it. It's just a matter of time. And then one thing was put in the shorter term. One thing I love about the macro in terms of the S&P 500 is, if you can take it, S&P 500, divide by 1,000, you have the same price of copper. And that's what I show you here. In white, it's copper. S&P in orange, it's the S&P 500. Got a little expensive, and and that's the 10-year yield in gray. I mean, they're all on the same scale, and they're all heading lower in a recession. So to me, that's the key thing to remember: is we might be able to avoid this recession, but it's almost inevitable now, because what's happened since we had that pendulum swing from, it's going to be, the whole world said it's going to recession, and then the whole world said we're not going to have a recession. And now what's happened this year when we tilted back is the Fed's raised another 100 basis points. So to me, this is the key thing to think about with risk assets. And the #1 factor is that U.S. government 2-year note. It's just oppressive. Right now, the yield, the dividend yield on the S&P 500 below versus a two-year note is about 370 basis points below. That's the cheapest, lowest dividend yield versus the 2-year note versus Fed funds since 2001. And here's one final chart I got to show you, and then I'll stop annoying with charts, because this to me is the most significant thing. That's a Warren Buffett model. Takes a little time to load. It's what everybody has forgotten, is that if you just take the S&P 500 and you divide it by U.S. GDP, just take that GDP in trillions times 100, and you have the S&P 500. That's what I show you here for 90 years. It's the most expensive now, the S&P 500 versus GDP. Same scale, implies that S&P 500 should go to 3,000. And that peak last year was the highest in 90 years. And what's really changed? Easy money, WIRP, the ZIRP. I'm sorry, zero interest rates are gone. It's reversed. And that to me is what's happening now. It's in the early stages. And if for this to stop reverting, we need rates to go down fast, or the dollar to go down fast. And what's it going to take for that? The dollar's breaking the global economy. The stock market probably has to just revert to this long-term relationship with GDP, unless we've reached a new higher, permanently higher plateau, which would be wonderful for everybody. I'm not the doom and gloomer. I'm just pointing out facts of valuation in history. And typically, one thing we need to remember is Bitcoin was born in this area of zero interest rates. We had no choice, ZIRP. Now we do. That U.S. government 2-year note gives you 10% in 2 years.
1 year ago, a pocket of borrowed money on the edge of UK bond markets imploded with enough force to topple a prime minister and draw the Bank of England into an emergency rescue. Now the world's most influential regulators are intensifying their scrutiny of a mounting potential risk to the gilt market's much bigger cousin, the $25 trillion U.S. government bond market. Over the past month, the Bank for International Settlements, a convening body for the world's central banks, and the U.S. Federal Reserve have both pointed to a rapid buildup in hedge fund bets in the Treasury market. The so-called basis trade involves playing two very similar debt prices against each other, selling futures and buying bonds, and extracting gains from the small gap between the two using borrowed money. Both the protagonists and the strategy itself are different from those involved in the UK's liability-driven investment meltdown last year. But they have one thing in common: the collision of heavy leverage with sudden and unexpected market movements and the speed with which that can cause potentially serious problems. The scale of the basis trade is hard to pin down. Even the Fed lacks precise data, but leveraged funds short positions in the most liquid futures contracts reached an all-time high of almost $900 billion in late August, according to Commodity Futures Trading Commission data. Such risks matter because the U.S. Treasury market underpins the global financial system. The yield on federal government debt represents the so-called risk-free rate that is the benchmark for every asset class. The short but destructive UK market crisis a year ago highlighted how quickly markets can become disorderly when leverage has been employed, an increasingly pressing concern for regulators focusing on potential problems that accumulated during more than a decade of super low interest rates. So what do you think about the gold rush going on in China and the recession in the US? Drop your comments below and remember to hit the like button, subscribe, and turn on notifications. Thanks for watching.